Good morning, everyone. Thank you for taking time to join our flood webinar today. I'm Nicole Frizzell from the marketing department. I'm really excited that you took the time to learn more about our unique flood program. Before we begin, we're just going to go through a few house rules. This is a live interactive webinar, so your microphones are turned on right now. So you do have the ability to mute yourself if there is background noise around you. So if you just want to take a second to do that, that would be appreciated. We want you to participate. So please interrupt and ask questions throughout the webinar. We will have a question and answer session at the end as well. If you're not comfortable shouting out, there is a question box feature in your control panel. You can type questions in that box and Nicole or Michelle will answer your question. We are recording this webinar as well, and you will get a copy of the recording and the PowerPoint presentation via email after the webinar. Be sure to stay tuned for the entire webinar. We are offering a contest, and we want to share the details with you about that contest. And you're also going to receive a survey at the end. Please, please, please take the time to complete this so we know how we're doing and some other topics that you'd like to learn about next. All right, I'm going to turn control over to our flood expert, Nicole Plews.
Hi, everyone. I'm Nicole Plews. I'm the flood specialist here at the Toscano Agency. I also double as an assistant underwriter in our property package and liquor department. I've been here at Toscano's for almost 4 years now, but some of you may recognize me by my maiden name, which is Nicole Lakin, because I was recently married in September. I'm super excited to be here today and share this information with you, and I have Michelle helping me out as well. Michelle, do you want to introduce yourself?
Hi, everyone. My name is Michelle Morton. I have worked at the Toscano Agency for over 17 years. I typically work from my home in South Carolina. I've been happily married for the past 13 years, and I have an 8-year-old son named Keegan. And I just wanted to say again, thank you all for joining us. And here is an overview of what we will be covering today. We're just going to go over who is Toscano Agency, why do your clients need flood insurance. We'll go over some basic flood knowledge, including what's the difference between our product with the NFIP. We'll go over our online rater and show you how to rate or submit a risk to us. We'll go over some of our recently bound accounts, and we are giving away prizes, and we'll have a Q&A. So who is Toscano anyway? The history of Toscano is we began as a wholesale broker in 1970 by our founder, Bill Toscano, on the front porch of his family home. In 1980, Rob Toscano joined the agency, followed by his sister, Ginny Toscano, in 1985. And together, they built the foundation of hard work and built the Toscano brand. We provide you with support, education, solutions, and we help our agents succeed. On top of all of that, we, of course, provide excellent customer service, and you will have a really good experience working with us.
Okay, so getting into the flood stuff here. Why do your insureds need flood insurance is the big question. So typically this isn't a choice made by the insured because if they do carry a mortgage, there's a good chance that they're going to be required by their lender to carry flood insurance when they are in a higher risk zone. So it's not only the case in high risk zones, though. We have seen it in lower risk zones where the lender requires it as well. This is a coverage that they're not going to get from their homeowners or renters insurance, so it's typically an excluded peril on those policies. Even with a commercial package, it's not something that they would have theirs either. So you do have to go elsewhere and get it on a standalone policy. Typically, the NFIP was the only option up until private markets were approved. So we're super excited that this is now an option for us to give you and your insureds. Being that floods are the most common and costly natural disaster, there are millions of dollars in losses each year paid out on flood losses. So even if your insured thinks they might not be at risk for a flood, we do see about 20% of the flood losses pay out in low or moderate risk areas. So they definitely are still at risk, even if they're not in those high risk zones. And then the next couple slides are just going to be some general vocabulary that you'll see when we're dealing with a flood policy. We just want to get you familiar with these and give you a little background so you know what we're talking about here with the flood stuff. So the first one's going to be a flood map. This is basically just a snapshot of a particular community. It's going to be shaded just like that picture shows there, shaded and highlighted in any of the higher hazard zones that are more at risk for flooding. So this is just FEMA goes out to these communities, pairs with them to identify their flood hazards, and then they use that information for floodplain management, and we use it for rating flood policies and determining where flood insurance is required by mortgage companies. On the flood map, you'll be able to find the flood zones, the floodplain boundaries, as well as the base flood elevation, which I'm going to get a little further into on the next couple slides. And these flood maps do change. I know a lot of our agents have experienced some trouble with flood map revisions. And the main way it affects the insureds is going to be if your insured's in an X zone, FEMA goes out and revises that flood map, there's a chance that your insured may move into an AE zone or another A zone that they would then be required to carry the flood insurance per their contract with their lender. So the reasons for the changes would be, land changes over time. So new land use, weather patterns, or erosion can cause changes to how the water would flow, as well as community development. So they are revised from time to time. And that's something we do need to be aware of. This will take me into our next slide, which is narrowing in on what a flood zone is. So this, like I said, is described on the flood maps, and this is typically determined by assessing a couple different factors, one being the expected height of a flood. If one to occur, how high the water would surface, as well as for coastal properties, the potential wave heights, and then the distance to the nearest body of water, which could be an ocean, a lake, a river, or even a creek. And then the ground elevation of that area is also taken into consideration. They're designated by letters. You can see in that chart below the different letters that are associated with the flood zones and the risk associated with that letter. So the higher risk zones are going to be any of your A zones, and your V zones are typically coastal areas. The lower risk zones will be designated by an X, typically, is the one we see the most. We are most competitive in the higher risk zones and the moderate risk zones, but we've also been able to compete against the NFIP in the lower risk zones as well. So feel free to send in any of those. We can definitely take a look at it for you. If you ever need to check a flood zone, there's a link there for you, but that's not something that you need to necessarily do before you send a submission in to us. We can definitely do that part for you. So if it's not readily available to you, we'll take care of it for you. Anybody have any questions on that part? Okay, I have one more vocab slide for you then. It's the base flood elevation. It's also referred to as the BFE often. So this is basically the height to which the flood water would rise if a flood were to occur. So it's kind of estimated because they don't know for sure, but this can be found on the flood map. Whenever it's a higher risk zone, you'll see the BFE designated on there. So basically how we use this in rating is we take this number and compare it to the elevation of the actual structure that we're rating. And you'll hear us say a lot of times, is it negatively elevated or positively elevated? Positively elevated would be when the structure is higher than the BFE. So that's a good sign. That's a good thing for us. It's considered ideal. The negatively elevated buildings are a little more tricky for us to underwrite. We do have to refer those over to the company. So this information can be found, like I said, on the flood map or on an elevation certificate, which we're also going to get into a little bit more here. And then that's how we basically use that information to rate up the risk that we're working on. Any questions? All right, I'm going to turn it over to Michelle.
So what is pre-firm versus post-firm? If you've written any flood coverage in the past, you may have seen these terms before. Pre-firm means buildings that are built or substantially improved prior to December 31st, 1974, or prior to the date that that community entered the program and the firm was established for this community. And post-firm is just the exact opposite. If it was built or substantially improved after December 31st, 1974, or after the community entered the program. Any questions about firm?
Hey, Michelle, we have a question. What exactly does FIRM mean?
That's a really good question. We just kind of throw that around like everybody knows what that means. It's actually an acronym for Flood Insurance Rate Map, and it's the official map of a community in which FEMA has identified the special hazard areas for that designated community. So, as you've seen in a few slides ago, the map with all of the red that Nicole was referring to, that is the official flood insurance rate map, or the FIRM. Any other questions on FIRM? Okay, moving on. So you'll oftentimes be asked for an elevation certificate. And what is an elevation certificate exactly? These are documents. This documents the building's elevation. So it's required to compare the estimated height floodwaters will reach in a major flood. It's needed when a risk is located in a higher risk zone, so in your A's, your AEs, anything A or V, and is post-FIRM construction. You'll typically be asked for an elevation certificate from a flood market. This typically provides the location of the building, the lowest floor elevation, the building characteristics, the flood zone, and the base floor elevation. So some ways that you can get an elevation certificate is just by asking the community floodplain manager. You can ask the seller when you're purchasing a property. If you know it's in a flood zone, just ask for that at closing. You can ask the developer or the builder. You can check the property deed, but if you can't find it in any of those ways, you may need to have one done, and that would require hiring a licensed land surveyor, a professional engineer, or a certified architect. Any questions about elevation certificates?
Michelle, we have a question. How much does it cost and how long does it take to get an elevation certificate?
Those are good questions as well. Typically, they run anywhere between $300 and $400. Depending on the size of the building and the location, could potentially go up to maybe $800. So figure in a few $100s there. Once it's done and it's submitted to FEMA, if it's submitted online, it could take up to 60 days. If it's mailed in, it could take up to 90 days. Any other questions? Okay, moving on.
Okay, so getting into what we have at Toscanos to offer you, and we want to make it very clear that this is completely separate from the NFIP and in no way related to the NFIP. So we're working through strictly private flood markets. We have a couple different markets that we're working with right now, all of which write on underwriters at Lloyd's of London paper, which is an A-rated company by AM Best. It is available in all of the states that we are licensed at Toscano, but you would need to also be licensed in your office in the state that the location or that the risk is located. It will be non-admitted for all of our markets, so there are taxes and fees involved. I know for PA, we wouldn't need a completed affidavit because it is an exportable class, so that's not something you would need to worry about on PA risks. Some of the things that we have to offer you, we can consider primary homes or secondary homes. So if you have a vacation home that you're looking for flood coverage on, we can definitely take a look at that for you. We can do commercial buildings and condominium associations. And not only can we offer the primary coverage, we can also offer excess coverage for you, whether it be over our own private markets or the NFIP. So we can offer a maximum total limit of $5 million on any one building. That would be combined between the building and contents. And then excess, we have up to $45 million. So those limits are well above what the NFIP can offer. So that's a strong selling point for us right there. We could typically combine if the insured has a primary coverage through the NFIP and then excess as well. We're typically able to take those two and combine them onto one policy for you, getting you those full limits. Our minimum deductible is going to start at $2,000 on the building and contents, and then our minimum premium usually is around $500 plus the taxes and fees, so usually around $600 in total. All right. Michelle's going to give you a little bit of an idea of what the difference is between our product and the NFIP.
So our product offers competitive pricing. We've found a number of accounts that have come in lower than the NFIP, some significantly lower than the NFIP. We offer the replacement cost coverage for the building and the contents. The NFIP only offers actual cash value. Our product offers business income and loss of rents coverage up to $500,000 on commercial buildings or apartments. The NFIP doesn't offer any business interruption coverage. Just keep in mind, though, that we would have to schedule this on the policy and provide a limit. It's not automatic, and it's not on actual loss sustained, so just keep that in mind as well. We have the ability to schedule multiple locations or buildings on one policy, which is not available with the NFIP. You have to have a separate policy for every building. We've got higher limit capacity than the NFIP. And with us, you're getting the Toscano concierge customer service. You will call us and get an answer, and you will not have to deal with the government and government shutdowns and not knowing if your customer's going to be able to extend their flood policy from one day to the next. You won't have to worry about that dealing with Toscanos. You can rate and issue right on our website, and one of our carriers actually offers no waiting period, even if it isn't required by the lender. As long as it fits the underwriting guidelines for that program, that one will have no waiting period. If it does go into one of our other programs, there's a 14-day waiting period if it's not required by the lender. Nicole will demonstrate our online rater for you.
Okay, so we were able to pair up with one of our private markets and set up a rater on our website that is available for your use. All you would need to get started is your Toscano login, and then you go ahead and get into our website, and you can access this one of two ways. There's our flood product page where the rater would be available right down here on the online rater, or if you get into your toolbox, you'll see a little online rating tab up here at the top. You click that and it would be under the flood rater. So there's two ways to get to it. I'm just going to go in from here. So it is super quick and easy, so I just figured I'd walk through it with you today just to give you an idea of how easy it can be. Like Michelle said, you can quote it and rate it and even issue the policy on our rater. So if it fits in the rater, it's definitely our go-to option. This is our main market that we use on here. So you would just want to go ahead and get into it. It's going to pre-fill your wholesaler, which would be us, the Toscano agency, as well as my contact information on there. This is where you would type in your agency name. So I'm just going to use, and then your first and last name as well. So this information would pull to the affidavit if it is outside of PA. Now, keep in mind, this is just for single locations. If you did have a couple buildings or a couple different locations to combine on one policy, you would just need to send that in to us via email because the rater is not yet equipped to handle multiple locations. So here's where you enter in your insured's name. So I'm just going to do the Toscano agency, keep it easy. And then the effective date that you'd like the policy to start. So I'll say today. And then the zip code that the risk is located. It should pre-fill there for the county and the city for you. Here's where that pre and post firm comes into play. So if you look over here, it has a little question mark. If you hover over it, it gives you a little hint as to what that means in case you forget. So just go ahead and click whichever one applies. If you do hit post firm and it is in a higher risk zone, it may ask for some information off of the elevation certificate that you will need to have on hand. But it does give you hints again where to find that information. So then you'll enter in the flood zone. There's a whole drop down here of all the different zones that you can select. We'll just say AE for this one. And then the type of building that you're working on. Again, it gives you a little hint. If you're going with primary dwelling, it must be owner occupied at least 50% of the time. Otherwise, it would be considered a secondary home. Apartment buildings, like I said, commercial buildings and condominium associations, all available to you in the rater. This one's obviously going to be a commercial building. I know a big question that we've had in the past is a lesser's risk dwelling. Where would that fit? If you're looking for business income coverage on a lesser's risk rental unit, you would need to put it under apartment buildings, 1 to 4 units. That way it gives you the option for the business income or loss of rent coverage. Otherwise, you can put it under the single family dwelling. It won't make a difference either way if you're not looking for that coverage. So we're just going to say commercial building on this one. Number of floors above ground excluding the basement. Just fill that one in. And then this is going to be your 100% replacement cost value. I'm just going to make this up, but we're just going to say 750, and then you don't have to carry the full replacement cost value. So this is asking you what limit you are looking to carry. We'll just say 250. You would select your deductible here. Like I said, it starts out at $2,000 on these ones. Contents replacement cost, same thing. You want to put in the full replacement cost value and then the amount you're looking to carry. And it does tell you there that medical equipment, perishable food, drink items are going to be excluded under this program, so you don't want to include that in the limit you're providing. Again, select your deductible. And then here is where you would enter if you were looking for business income or rental value. If you don't want that coverage, you can put zeros in there, but it will require you to fill it in to let you move forward. Down here at the bottom, it's going to ask you if it's within 5 miles of any body of water. So if it is indeed, you want to hit yes, and then it'll bring a few more questions up for you. If it's within 5 miles of a coastal body of water, gives you little hints under here again, makes it really easy. You want to hit no there. If it's located within 5 miles of a river, yes or no. And then a lot of times what we see is that it's within 5 miles of a creek. So if that is the case, you would hit yes for the first question because it is within 5 miles of a body of water, and then no for the remaining 3, which is actually the case here at Toscano. So I'm just going to hit no on those and then go ahead and move forward with getting my quote. So right away, it gives me an indication of what kind of premium I'm looking at based on the values I put in. So you can select building only, or you can go ahead and click building and contents. It'll check that indication for you and then keep on moving. And these are the only underwriting questions you're going to have to answer on this one. They're pretty straightforward. Asked about a basement. Now it does say below grade on all sides. So if it's a walkout basement on one side, you would hit no on there because it's technically not below grade on all sides. Keep on going down, just some general questions. And then the big one is if it has prior flood losses. If that is the case, you will need to hit yes. It's going to ask you to refer it over to us. If none of these apply, you can go ahead and hit answer no to all. It'll pre-fill them for you, and then you're able to keep moving. If you do hit yes, it'll give you a pop-up that says it's ineligible for our rater. Doesn't necessarily mean it's not eligible for our program, so you'll just need to manually email that in to us for further review. But for this one, we're going to go ahead and say no to all those. All right, last page, you just want to put in your property address. And then is this a primary residence, or if the mailing address is different, you'll need to enter that in there. Give us a quick business description, what's going on at that office. We'll just say insurance office, and a quick brief overview of the content. So if it was a restaurant, you could say cooking equipment, tables, chairs, that kind of thing. We'll just say office equipment for this case. And then the construction type for that building. Down here is where you would add your mortgagee. Once you put that information in, it'll show on the policy and on the quote for you. If you don't have the loan number, you can put TBD. It's not necessary to put it in at the quoting. We can fill it in later. All right, and then the next screen is just going to be if an elevation certificate were required, or if you wanted to upload any other documentation that you may have, such as a flood determination file. You can upload those files here. In this case, you don't necessarily need to, so we'll keep on moving. And then this is going to take us to our last screen, which is where we view the quote. There we go. So it's going to give us the quote right here, and then you can print out your quote using the print function here, and you have a quote in hand, and it is bindable for the insured. So if the insured decides that they're good to go, they want to go with this quote, you just use, the rater actually sends you an automated link as soon as you get past the first page. So you're going to keep that automated link. If you ever delete it accidentally, I could certainly resend it to you because it also kicks me a copy of that link. And that's what you would use to get back into the rater at any point and edit your quote. And then when you get to the very end here, you'll see there's a purchase policy button. So this is at the point where the insured's ready to roll. You have the payment in hand and ready to go. You would hit purchase policy. It's going to have you electronically sign all of the documents that are needed. And then you'll have a policy in hand to be printed for this insured, so that you're pretty much done at that point, which is super slick because then you can print the policy out and hand it to the insured right there. Then it kicks a copy over to our office and we'll get it set up in our system and ready to go. And then we will send you the invoice. It is special payment terms, so right now the payment would be due to our office within 5 days of the effective date. And that's pretty much it. It's super easy, and they make it pretty easy. But like I said, if it doesn't fit in the rater, it doesn't necessarily mean it's not available to you through our other markets. Does anybody have a question on that one? I know that was a lot. Okay. All right, so when you're submitting a risk, if you want to give the rater a try, that's one way to do it for sure. We definitely like you to try it just to see how it flows for you and get some feedback as well. If you're not feeling the rater, you can certainly feel free to send that over to us in an email to submissions@toscano.com. You can CC me in on it if you'd like to get a quicker look at it. So we would just need the current NFIP deck page, or if they have a current private market that you have a quote through, we'll take that as well. We can usually quote off of that information alone. Otherwise, we would need a completed application, which is available to you on our products page or on our website. If there is a basement, we do ask for an estimated value of machinery and equipment in the basement, such as the furnace or the hot water heater, those types of things. And then if it is a post firm in a higher risk zone, we will need an elevation certificate for binding, but not necessarily for quoting. Occasionally, we are able to get through quoting process without the elevation certificate, so don't hesitate to send those over if that's something you don't have up front. All right, any questions on how to get a risk over to us?
Okay. Yes, awesome. We have a question that came in, Nicole. Hold on one second. So the online rater provides a quote for one company. Will you shop it around for us with other available carriers if it does not fit the rater?
Okay, good question. Definitely. The rater is for one specific carrier, so that is typically our go-to market. So if it fits in the rater and you get the whole way through and get a quote, that is going to most likely be your best bet out of our private markets. So we would typically stay with that one. If it doesn't fit in the rater and you have to manually send it in, we do send it out to all of our markets and try and get a quote that way for you. So yes, we definitely do shop it out if it doesn't fit in the rater, but if it does, that's going to be our best option. Any other
Nicole,
questions
we've got another
on that?
question.
Sure.
What payment options are available?
So it is agency billed, so it would be pay in full, but we do offer a finance contract on it. We can offer financing on it through our Highland Premium Finance in-house financing company, so that would give the insured options to pay via installments as well.
Okay, Nicole, we have one more question
Sure.
One more came in. The NFIP pricing and private flood pricing are the same. Is this true?
No, oftentimes we're going to be, we've done a lot of comparative rating with the NFIP policies and the private market policies, and I would say 9 times out of 10, our pricing is going to come in lower than the NFIP, just depending. Now, when it comes to risks that are grandfathered in with the NFIP, that just means that they've had a set rate for a long time on that risk. They've been with the NFIP for a long time. Now, we're not as competitive when it comes to grandfathered rates because they have a low rate to begin with. So we're not always as competitive with them. We can still take a look at it for sure, but otherwise private markets do tend to be lower in premium than what the NFIP has to offer. Anything else? All right.
So some of the risks that we do not have markets for are risks that are located in suspended cities, medical equipment, fine arts, perishable goods. So if you've got a risk that's got a ton of perishable goods in it, like a textile manufacturer or paper goods manufacturer or something like that, none of our markets will quote that. If you've got a property built on stilts over water, mobile homes, or risks in CBRA zones, those are risks that we would not be able to quote. Any questions on anything on this slide?
Michelle, 2 questions. What is a suspended city and what is a CBRA zone?
Okay. So a suspended city is a community could be suspended for failure to adopt a floodplain management procedure or if it fails to enforce its floodplain management regulations, it can be suspended. A CBRA zone that's the Coastal Barrier Resource Act. And basically it protects the coastal barriers against wind and tidal forces caused by coastal storms, and they serve as habitat for aquatic species.
And I did want to add in, we can't consider the suspended cities, but we can consider non-participating communities. So if they are not paired with the FEMA at all and have never, been paired with the FEMA maps, then we can definitely consider the non-participating. But with suspended, those are communities that haven't followed their floodplain management requirements, so we're not looking to cover those.
Okay, we have one more question that came in. Can you include contents in a below-grade basement?
No, so we're not going to look to cover any contents in the basement, whether it be finished or unfinished. Unfortunately, that's something that none of our markets will do. I'm not sure that we found one that will. They do consider the machinery and equipment in the basement as part of it, but we can't do any of the contents. Okay, so this is just to give you an idea of some recent successes we've had, some accounts that we've bound. It's kind of all across the board. We had a 14-unit apartment complex, which was a new venture, some mixed occupancies along the coast, a vacation home along the coast, a used car dealership right along the Susquehanna River, and then we had a bed and breakfast in Cape May, New Jersey, all of which I want to say almost all of these have switched from the NFIP to our private market program and saved some significant money. That last one there saved nearly $4,000 from the NFIP, switching from the NFIP. So it's definitely some savings for the insured and a much easier option to not deal with the NFIP and go through our private markets. The next slide's just going to give you a couple of helpful links that we use to put together this presentation if you ever need to refer back to them. And then getting into the next slide, which is the fun stuff. As Nicole mentioned at the beginning, we are giving away prizes. So we really want to take advantage of our private flood markets and offer this product to your insured, being that it is more affordable than the NFIP and a lot easier to use. So we are going to go ahead and push this incentive for you. So anyone who participated in our webinar today is up for $10 gift cards for every new flood policy that you bind beginning today through April 28th. So we're going to run it for about a month long. Every new flood policy you bind with us, you get a $10 gift card. There is no limit. So it's the more you bind, the more gift cards you get on this one.
Okay, and some upcoming stuff we've got. What's next? We are working on our 3rd garage webinar to really go deep into coverages that garage owners need. That's on April 30th at 10 o'clock with Ryan Moore and Annie Miller. Hopefully you'll be able to participate in that as well. And then the next slide lists the rest of our upcoming webinars for April, so you can take a look at the dates that are on there as well. So I believe Michelle's going to open up for questions and answers right now. So please participate.
Does anybody have any questions about flood, our flood product, how to get in touch with us, anything like that?
Yep, we have a question that came in. We had a flood in 1972. Would these risks be eligible?
Okay, I can take that one. So with flood coverage, it is a little trickier because their loss history does go back pretty far. It's not like most like commercial policies where the floods, they ask for 3 to 5 years loss runs. So flood does go back pretty far, but that's definitely something, it's been a significant amount of time. So we would definitely take a look at that for you if you want to send it over. It would need to be referred to our companies, but it is something we can consider. The amount of time that has been between now and the loss is a positive on that one. If they do have repetitive losses, there's a good chance that we're not going to be able to write those, especially within a short period of time. They would have to stay with their NFIP repetitive loss policy on those. But if it's like a one-off, we can definitely take a look for you. We like to have as much detail as you have available to you about the loss and the circumstances, as well as the payout on there, because that is helpful in us selling that policy to our markets.
And another question, for a condo association, must the building be a minimum of 4 stories?
Per their guidelines, it does say a minimum of 4 stories, but that's something that we may have a little leniency on. I would have to double check with our carrier on that one to get a for sure answer for you. That is what their guidelines say, but I don't see why we couldn't consider less than that as well.
That could also be one that we could try all of our markets, not just the one that is our preferred. So I would suggest sending it in. Anytime you're on the fence about anything, please call us, because if we don't know, we would like to call the markets and just make sure that that's something that they will or won't consider before we turn it away. Any other questions?
Okay, well, if that's it, we definitely appreciate everyone being here today. We appreciate you taking the time to learn more about our flood product. We know everyone's busy, so we really do appreciate you joining us. I know Nicole had mentioned before they're sending out a survey at the end of this, so if you could take a quick minute, let us know how we're doing, what we can improve on. We definitely appreciate that as well. And thank you.